Welcome to Relax, We Got It. A public limited company, PLC, is a type of company in which the shares are traded publicly on a stock exchange. In a PLC, the liability of shareholders is limited to the amount of their investment in the company. This means that if the company faces financial difficulties, the shareholders' personal assets are not at risk beyond their investment in the company. Characteristics of a public limited company. 1. Legal entity. A PLC is a separate legal entity from its owners, which means that it can sue or be sued, and can own assets in its own name. 2. Limited liability. The shareholders' liability is limited to the amount they have invested in the company. 3. Large capital base. PLCs can raise a large amount of capital by issuing shares to the public, which allows them to finance large-scale projects. 4. Minimum number of members. A PLC must have a minimum of 7 shareholders. 5. Public ownership. The shares of a PLC are traded publicly on a stock exchange, which means that anyone can buy and sell them. Advantages of a public limited company. 1. Access to capital. PLCs have access to a wide range of investors, which allows them to raise large amounts of capital. 2. Limited liability. Shareholders are only liable for the amount they have invested in the company, which means that their personal assets are not at risk. 3. Perpetual existence. PLCs have perpetual existence, which means that they can continue to operate even if the ownership or management changes. 4. Brand image. A PLC's shares are traded publicly on a stock exchange, which gives it a strong brand image and enhances its reputation in the market. 5. Professional management. PLCs are required to have a board of directors, which ensures the professional management of the company. Disadvantages of a public limited company. 1. Expensive to set up. PLCs are expensive to set up and require a lot of paperwork, legal fees, and compliance with regulatory requirements. 2. Disclosure requirements. PLCs are required to disclose financial information to the public, which can make them vulnerable to competitors and affect their strategic decisions. 3. Loss of control. Shareholders may lose control over the company if they sell a large percentage of their shares to the public. 4. Bureaucracy. PLCs are subject to more bureaucracy and regulation than other types of companies, which can slow down decision-making and reduce flexibility. 5. Short-term focus. Publicly traded companies are often focused on short-term profits, which can lead to a lack of investment in long-term projects. In conclusion, a public limited company is a type of company that has its shares traded publicly on a stock exchange. It has several advantages, such as access to capital and limited liability. Also has some disadvantages, such as expensive setup costs and loss of control. Thank you for watching our video. Hope you liked it. Like, share and subscribe.